Welcome to the Explainer. Today, we're pulling back the curtain on a really important accounting standard, one that gives us a crucial mid-year peek inside public companies. We're talking about International Accounting Standard 34, which is basically the official rulebook for interim financial reporting. So let's set the scene. Imagine you've got some money invested in a big player on the JSE, a company like Sasol or MTN. You read their big annual report and things look pretty good, but that was months ago. How can you be sure they're still on the right track? Or, more importantly, how do you spot trouble before it's too late? Well, that's exactly the question we're digging into today. All right, here's how we're going to break it down. First, we'll talk about this problem called the information gap. Then, we'll introduce the solution, which is IAS 34. After that, we're going to look inside a typical interim report to see what you get. We'll cover the golden rules that make them trustworthy, and then we'll wrap it all up with why any of this actually matters to you as an investor. Okay, let's start with the basic problem that needed solving in the first place. You see, in the world of business, things move incredibly fast, and a full year, well, that can feel like an eternity.
Don't get me wrong, annual financial reports are brilliant. They are incredibly detailed, they're audited, and they give you this really deep, comprehensive look at a company's health and performance. Honestly, they're the foundation of any serious investment analysis.
But here's the big catch, right? All that amazing, rich information, it's just a snapshot. It's taken at one specific point in time, and it only comes out once a year. The second it's published, it starts to get stale. I mean, just think about it. In 6 months, so much can change. You could have massive shifts in the economy, a new competitor could pop up out of nowhere, supply chains could get completely disrupted, or maybe the company launches some game-changing new project. The business world just doesn't stand still.
And this is where the real danger is. This gap, this information vacuum, it means people are making huge decisions, buying, selling, lending money, based on data that could be 6, 8, even 10 months old. It's kind of like trying to drive your car forward by only looking in the rearview mirror. You're completely missing what's happening right in front of you.
So that brings us neatly to the solution. Let's look at how this standard, IAS 34, steps in to fill that massive information gap. It's essentially the global playbook for this essential mid-year checkup. The standard gives us a really clear definition. An interim financial report is just what it sounds like, a report for a period that's shorter than a full year, so usually 6 months or maybe a quarter. And it can be the whole shebang or, more often than not, what they call a condensed version. This quote from the standard itself really nails the whole point of IAS 34. The entire reason it exists is to empower people, investors, banks, you, me, with fresher, more timely information so we can all make smarter, better informed decisions. And this just goes to show you that IAS 34 isn't some ancient, dusty rule that's been sitting on a shelf. Nope, it's a living document. It started back in 1998, but it's been updated constantly, with the latest tweaks happening as recently as 2024, just to make sure it stays relevant and in line with all the other modern standards. Okay, so a company puts out its interims. What are you actually going to find inside that report? What does this mid-year checkup actually look like? Let's dive in. So, to make things faster and more efficient, IAS 34 allows for a condensed report. The best way to think about it is like this. The annual report is the full 3-hour feature film. The interim report, that's the action-packed 2-minute trailer. It gives you all the key plot points, performance, financial position, cash flows, but it does it with shorter, high-impact notes. And here they are, the 5 things that absolutely have to be there. These are the non-negotiables. According to the standard itself, any interim report that says it follows IAS 34 times must have these 5 components. It creates a level playing field so we can compare apples with apples. But the real gold is in those selected explanatory notes. See, the report isn't supposed to just rehash old news from the annual report. Its whole job is to tell you what's new and what's significant. Things like a big asset write-down, a major court case being settled, or a huge acquisition. This is the stuff you really need to know now. All right, so for any of this to be useful, we have to be able to trust it, right? The reports need to be reliable and consistent. And that's exactly where the golden rules of IAS 34 come into play. They build that foundation of trust. These 3 principles are really the bedrock of the whole standard. First, you have to use the exact same accounting policies as the last annual report. No funny business or changing the recipe halfway through the year. Second, everything is measured on a year-to-date basis, recognizing that this is just one piece of a bigger puzzle. And third, materiality, or what's considered important, is judged against the interim period itself, which means important short-term events don't get swept under the rug. And that right there is the whole philosophy in a nutshell. An interim report isn't a standalone story. It's a crucial chapter in the company's year-long financial book. Every single number and every disclosure is framed with that bigger context in mind. You know, the standard is also pretty practical. It flat out says that to get this information out quickly, companies are going to have to rely on estimates more than they do for the big annual report. And you know what? That's perfectly okay, as long as those core principles are still being followed. Okay, so we've talked about the what and the how. Now, let's bring it all home and focus on the why. Why is a standard like IAS 34 so incredibly important, especially for a market like ours here in South Africa? Well, the benefits create this amazing ripple effect. Investors obviously can make much smarter calls. Banks and other creditors can get a better handle on risk. It boosts the overall confidence and transparency of the JSE, and believe it or not, it even helps the company itself by forcing better internal discipline throughout the year. Everybody wins. And let's make this really personal. So many of us have our savings, our retirement annuities, our pension funds tied up in these JSE-listed companies. So IAS 34 isn't just some abstract accounting rule. It's a powerful tool that gives us clearer, more frequent updates on the health of the very businesses that power our economy. It's about reducing uncertainty and helping all of us make smarter financial choices. So I'll just leave you with this thought. The next time you see a company release its interim results, you'll be able to look past the flashy headlines. You'll understand the structure, you'll know the rules, and you'll know exactly what to look for to piece together the real story of what's been going on for the last 6 months. Thanks for joining me.